It was a quiet Monday. Markets barely moved. Headlines look calm, but deeper, if you look, you'll see a storm quietly brewing with Trump's pressure on the Fed intensifying. Treasury's borrowing needs just exploded past 1 trillion, and new data suggests consumers are one rate cut away from unleashing a wave of spending. In today's market update, we're breaking down what these subtle but powerful shifts mean for inflation, rates, and future growth here in the United States. This isn't just another day in the markets, it could be a turning point before the next big move. So first, let's talk about Trump and how he turned up the heat on Jerome Powell. So President Trump's visit on the Fed was part of what you'd call a theater event, part pressure campaign. After weeks of public jabs at Jerome Powell, Trump toured the central bank's headquarters and privately suggested Powell might be ready to cut rates. Markets are watching this one closely, not just for rate changes this week, but for signs that the Fed is potentially bowing to political pressure. And the optics would be tense, is what to pay attention to. Powell's independence is under the spotlight, and any hint that the White House is somewhat influencing monetary policy could shake confidence and push yields higher. Hence, borrowing rates go higher, contracting the economy. Former Fed officials say Powell is unlikely to cave in to what Trump wants, but Trump's goal may be a little bit different than what they're assuming could happen, to force Powell to step down entirely when his chair term ends next May rather than staying on board as a governor. That would give Trump full control of the board and the power to steer monetary policy heading into the 2026 election for the Fed chair, but we'll keep on watching how this one progresses. Now, the next topic will be the Treasury's $1 trillion debt bomb that's going on. The Treasury just shocked markets by announcing over $1 trillion in new borrowing for this quarter alone. Just this quarter, nearly double what they projected just months ago, not too long ago. And you might question why, and there's really two main reasons here. The first one is Trump's massive tax and spending bill that passed July 4th, the One Big Beautiful Bill. That's going to be, it's going to be so great. And then the Treasury's cash balance has run dangerously low. Now they're making up for the lost time, and Wall Street is paying attention to this one. Most of the debt will come in the form of short-term bills, not long-term bonds. And the reason why is because Treasury Secretary Scott Bessent wants to avoid locking in high rates, but that strategy has risks that comes with it. Short-term debt leaves the government exposed if inflation rises or demand dries up. And Wednesday's refunding announcement will really be key to what to expect next. Any signal that long-term debt issuance is coming sooner than expected could rattle bond markets fast. And remember, bond markets and bond yields are important because it impacts what inflation expectations prove to be and how borrowing costs can shape out to be. So the next topic we're going to talk about is trade tensions and tariff diplomacy. So over the weekend, Trump met with the European Union and made a trade deal, and that is now done. And now all eyes turn to China, South Korea, and India for how these trade talks will resume out. Over 20 countries face looming tariff hikes unless deals are reached by August 1st, and we're expecting more deals to be announced as we get there. We're just a few days away, with this Friday being that deadline. And so far, we got this emerging pattern beginning to shape out. Trump is locking in 15 to 20% tariff rates as the new norm. Forget that 10% baseline that was expected. It's a bit higher than that. Some nations like Vietnam and Indonesia have already struck deals, but also others like Canada and Taiwan are still really in limbo and hard to make deals with. So the biggest wild card here would be China. Talks have resumed in Sweden this week, and the 90-day trade truce extension is expected beyond this August 12th deadline, but it's not a done deal just yet. Markets are cheering the momentum, but economists warn that these deals will fuel inflation in the medium term, more tariffs, more price pressures, and how does that impact both consumers and the Fed? But speaking of consumers, consumer resilience or a credit time bomb. one would say. So credit card delinquencies are falling, charge-offs are improving, and household debt servicing remains low by historical standards, which is all good news, right? But wait, there's more. There's a twist. Consumers aren't borrowing much, and credit card usage is rising slowly, only about 3% year over year, and subprime lending is way down. Now, why is this the case? It's not just debt, it's the cost of debt. Average credit card APRs are still above this 20%, 22% figure, even as Fed rate hikes pause. But if the Fed cuts, that could change things fast, and analysts say one solid rate cut could unleash a wave of consumer spending, especially from lower income households sitting on unused credit, just because it's so expensive to borrow money right now. And we just talked about Treasury yields and how they impact borrowing costs. So if we see these yields start going up like we mentioned earlier in this video, that could have damaging effects to people who do rely on credit right now, just because, yeah, the economy is resilient somehow, but everybody I seem to talk to are down bad right now. It's hard to find a job if you don't have a job. Prices are expensive. Wage gains aren't necessarily keeping up unless you just really got a good job and good skills that are high in demand right now. But I'm telling you right now, the majority of people, that's not the case for. So for now, spending is stable and holding up, but it's fragile. And the Fed knows a wrong move could open the floodgates to complete disaster. Now let's talk about the housing market. Investors step in as buyers really back off. So these high interest rates and surging prices have sidelined many individual home buyers, but investors on the other hand, they're back and they're dominating the market. They're really the ones shining right now, with nearly 30% of single family homes purchased in 2025 have come from investors, especially these smaller firms buying below that $300,000 property range and renting out the properties. And big players are beginning to slow down, but these local investors are snapping up the discounts as builders race to clear inventory. And I'm just wondering how this one plays out. This surge is reshaping the market and raising concerns about long-term housing accessibility. Home prices are flattening nationally, and regional differences are growing in places like Florida and Idaho. We're seeing prices are falling, but here in the Midwest where I'm at in Oklahoma, they're still surging, but it all depends on the property and what the price is at. Like some people, yeah, I'll sell my home, my $200,000 house, if I could get $1 million for it. So there's a ton of factors at play here, and it's not very clear when you look at this national data. So that's why it's important to get more into the weeds of it, but they don't make it that clear. But it may have been a quiet day overall in Wall Street, but under the surface, the next big shifts are already taking shape, and it's up to us to pay attention to it. The Fed, the Treasury, the global trade map are all in motion, and the signals from today's news are clear. This calm won't last. Watch Powell's press conference coming up. Watch the debt announcement. Watch these tariff headlines, because the next leg of this market might be shaped not just by earnings, but by policy and all of these moving pieces. Thank y'all for being here, and I'll see you next time.